Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen along with our co-host Anthony Faso. We just wrapped up part 2 of our frequently asked questions.
And on those, we're going to continue with those questions. The next one will be, when can I take my first policy loan? And also, what happens if you can't make the premiums? And also a question is, am I too old to get a policy?
And then we've also got, is this FDIC insured? Can I buy a policy on my parents? And should I buy a policy on my kids instead of me?
Enjoy the episode.
Take care. Number 8, what we've got down here. Yeah, well, number 8 is when I get killed by the agent's high commissions. And you're right, we did touch on this earlier. Just to paraphrase and summarize is the way that we're designing policies is completely different than somebody else down the street, your brother-in-law or whatever they're doing is, man, we see these policies all the time that people are told are set up to be a cash value or an infinite banking policy, and in fact, they're not. They're 100%, almost 100% set up for death benefit, and there's very little, if any, cash value. What we do is we do the exact opposite. What we're trying to do is we're trying to get as much cash inside of this policy as we possibly can, and so we do minimize the death benefit. And then to kind of relate it to that last question is that's where we bring in the term insurance, right? Is we do need to make sure that we've got somebody covered up to a certain amount based upon their situation. So, right, the commissions that we take are much, much smaller than anybody else in the industry. So.
Yeah. Typically, the other person's making 2.5 times amount for the same premium. But that's why the way we design it, you have that early cash value. Yeah. Because the company's not having to pay the commissions.
Number 9. When can I take my first policy loan?
I think you already answered that.
We did.
Right? Typically, the first one at least a minimum after 30 days from your policy. Yep. From your policy being issued.
Number 10. What happens if I can't make my premiums? We kind of touched on that too.
Well,
there's a couple other options. Yeah.
I mean, the main thing is we want to make sure, ideally, we have enough cash value in there. And so one thing we can do, well, we got a lot of options.
We do.
Right? A lot of times with the flexibility of the premium, let's just use a round number, say your premium's $10,000, right? The base is what has to be paid, and that base is probably between $3,000 and $4,000.
Yeah.
So that the PUAs, which I've been calling the want to, is going to be the difference. So that might be $7,000 to $6,000. So the PUAs or the want to are optional. So you can easily lower that premium from 10 down to your base, and let's just say 4, right? So very quickly through a phone call, we can drop those premiums down. Mm-hmm. Okay, but also ideally we should have some cash value in there for times of need, and we can take a policy loan to pay the cash value.
Absolutely, and I'll add a third option on there. To extend your example was total premium or annual premium for the year is $10,000, and let's say that we have $4,000 that's going to be the base premium. Mm-hmm. Option 1 that Anthony just discussed is, hey, let's defer paying that PUA later, or maybe we skip it this year, and so now we're down to $4,000. Sometimes, like I mentioned, is our checking accounts don't line up with premium notices, and so we have the option of changing the billing mode on that $4,000. So you don't need to pay it as an annual mode. You could change that over to monthly and end up paying just a few $100s a month to keep that policy in force until the next deal comes in, things like that.
Perfect.
Yeah.
All right, the next one we have.
Number 11. I think I'm going to throw this to you, Grandpa. Because you're dealing with this right now. Number 11 is, the question is, I'm too old. Anthony, what do you say to people when they say I'm too old?
I would say you're not too old. Well, you're not. I mean, the way here's what I say. If we were to put the way we design this policy very different. A lot of times people are just thinking about life insurance and the death benefit, but the way we design it is very unique. So we have a $10,000 premium on the 40-year-old, $10,000 premium on the 60-year-old. Okay. Now, Cameron, out of those two, who's going to have more death benefit?
The 40-year-old.
The 40-year-old. Why?
Because they're younger and insurance cost is going to be cheaper.
And also, they're going to live longer, so insurance companies are going to collect more premiums. So the death benefit they're going to give you at the beginning is going to be higher. Because if you remember from the example we mentioned earlier, is that the way policies are structured is the cash value is going to equal the death benefit. So somebody who's younger, they have a longer period to accumulate the cash value. But Cameron, the way we design these policies with the base and the PUA, so who's going to have more cash value in year one?
They're going to have the same amount of cash value.
Exactly. So if you're doing this for cash value, the cash value is the same.
Mm-hmm.
If you're doing it for death benefit, then you're going to get more bang for your buck on the younger generation. I will say if you stretch this out maybe 10, 20 years, the cash value is going to be higher for the 40-year-old. I mean, there's a lot of things we can look into it because really probably who's going to pass away first?
60-year-olds.
All right, so then there could be a play for a windfall for the next generation. But that's why when you're designing these that we want to look at the big picture. Yep. So sometimes we may design it differently, but I will say you are not too old. In fact, we even had Dick Dykeman in here a couple weeks ago, and he didn't start doing IBC till he was in his 60s.
Mm-hmm.
And I know I got a policy on my father-in-law when he was 72. So I would say you're not too old.
The way I'd say that is that I typically don't say this to somebody's face because it's kind of blunt, but I'm going to put it in the podcast, right? Is if somebody comes in and they say, hey, I'm 60 years old and I'm too old to get this thing started, to be totally honest, it's my opinion that they're being short-sighted, right? Is they're only looking 5 to 10 years out in the future. And at 60 years old today, man, realistically, you should be planning to live to 90, at least 90, if not age 100. And so that is 30 or 40 years of managing your finances. And again, what we talk about is infinite banking is really just a cash management tool. And so for somebody at 60 years old to say that, that's usually what goes through my head. I don't ever say that to somebody's face, of course not. But I'll try to bring up some points and stuff. But that's usually what comes to mind is we got to step back, look at a bigger picture when that comes up.
Now our next question, is this FDIC insured?
Ooh. Good question, and the answer is no. It is not FDIC insured. So when you put your money at the bank, right, there's FDIC insurance that covers that, and it was raised back in 2008, 2009 from $100,000 to $250,000. So what that means in layman's terms is I've got $250,000 at the bank, and for some reason that bank, I'm missing the word, collapses, goes under, right? Then FDIC insurance will kick in and they will pay me my $250,000. I'm going to get a little cynical here. Who is the FDIC?
That's a really good question, but it's a corporation, but it's funded through a tax to the banks, and if they don't have enough money, it's funded by you and me, the taxpayers.
Exactly, right? So FDIC insurance at the end of the day is really just taxpayers' money being paid back. I'm not a big fan of that FDIC insurance coverage, but if we were to compare that, right, with what happens inside of an insurance company, is number one is there has never been someone that has lost a single dollar in whole life insurance because of the failure of an insurance company. And if you look at the history of mutual insurance companies and their failures, man, I think there was one or two back in the early 80s, and they failed because of mismanagement. It wasn't because of their practices, I guess, or the model of the business. It was more internal. So that's usually what I say, right? It's not covered by FDIC insurance. It is state regulated, right? And so when you look at kind of how insurance companies handle money is they don't over leverage. I don't know how far you want me to go. I can keep going down this, but when you put money on deposit at a bank, right now I think if you put $1 at deposit on a bank will then turn around and leverage or loan out $12 to $13. if you go and you put one deposit at an insurance company, is they don't have that ability to leverage, right? And so when you look at the solvency and the financial stability of insurance company versus banks, it's night and day. Insurance companies just don't fail. They've been around for 200, 250 years. Or if you look at just our last crisis in 2008, 2010, there was hundreds and thousands of banks that failed over that time frame because they were over leveraged. So usually when somebody's asking about FDIC insurance, is they're worried about losing their money. And at that point, you got to look at the financial stability of insurance companies versus banks.
Now, in 2008, Cameron, and I think you know this, how many banks failed in 2008?
Ooh, 500?
No, 499. No, I'm serious. It is 499, right? Do you know how many mutual life insurance companies failed during that same time?
0.
Right? And what I like is one of the movies that I watch on around New Year's Day is It's a Wonderful Life.
Yeah.
Right? And you had the Bailey Savings and Loan. And they had 2 crises. If you remember, one is everybody wanted their money back. There was a run on the bank, just like you were talking about. But because they had loaned the money out for Susie's roof and this guy here, and they loaned all money out, that they didn't have it. So George actually had to pull his honeymoon money and to make the bank solve it again. But there was another crisis the bank had, which was Uncle Billy lost the deposit at Potter's place. Do you remember that?
Mm-hmm.
And do you remember? Oh, so now, of course, the bank examiners were coming in the next day, and they were going to be closed and shut down because they lost the money. Do you recall how George saved the bank?
I believe it was cash from his life insurance policy.
Cash value from his life insurance policy. So this infinite banking has been... Nelson wrote the book 20 years ago. But he's the first one to say he didn't come up with borrowing against a policy. It's been going on for years. He was just the first one to actually put it in a book and start sharing the idea of the concept.
Yep, awesome, good information. Move on to question number 13. We're almost done.
Yeah, let's do it.
Yeah, can I buy a policy on my parents, Anthony?
Well, the answer is yes. I mean, I have one on my father-in-law.
Mm-hmm.
Now, more the other question is should you? Right? We at first want whoever we'd want you to maximize your coverage.
Yep.
Right? Because you're like for me, we have I want to maximize my death benefit. So a lot of times any money I'm putting policies on me and my wife is our main goal. Sometimes we do go off on to other people. Like I have a policy on Becky. I mean, she's wicked awesome. If something were to happen to her, we would be lost. But I'm also looking for other places to store money. So, and this is commonly can be used, say if you're not healthy. Maybe if you're not insurable, then you just need a relationship of somebody that you have an insurable interest in, which means the insurance company will allow you to get a policy on somebody. You have some sort of financial risk. That could be on a business partner. It could be on a family member.
So you just mentioned financial risk, and one of the questions that we bring up to clients when we're first getting to know them is, hey, is there a financial obligation that is expected or may be expected that you may have to pay for your parents, right? So are they in ill health, right? If something were to happen to one of them or both of them, is there a cost that's going to be associated with that? And if so, then we may want to consider putting a policy on them. And we can design it the same way, right? We can design it for a cash value so that it has that cash that's able to grow, and then we can also make sure that we've got enough for the death benefit. But that is a common occurrence. I've got a bunch of clients that have policies on there, and to be totally honest is, man, sometimes people bring it up and they go, oh man, that's a crazy idea, right? I've never thought about that, buying a policy on my parents. But at the end of the day, if there's a cost associated with the health care, somebody's going to pay it, right? More than likely, it's going to be a kid. And so for me, if you look at that scenario, it's not about getting rich in that situation or wealthy, right? It's about becoming whole, right? I'm going to make that payment, right, to make sure that my parents are taken care of or whatever to the best of my ability. And having that policy as that backstop is really just a way for me to get my money back. And so it's about protection overall and making sure that you're in a position to be able to pay those dollars for the health care.
Well said, Cameron. The last question. Should I get a policy on my kid instead of myself?
Great question. We get this one a lot. And the misconception that I will say is that people think, man, you know what? I think if I'm not preferred plus or top of the table, whatever it is, maybe I should get a policy on my kid because they're healthy, right? There's nothing wrong with them. The answer is, number one, is you should always fully insure yourself and your spouse before looking at a kid or a parent. And so when you move down to the kids is, yes, you should, right? In my opinion, you should have a policy on the kid. I use it as a savings vehicle and how to teach kids money, or teach my kids about money is I have money I'm putting into policies. And the way that I'm going to do that is, I've already done this with kids, is take a loan for something that they want and have them pay the policy back, right? So you have that opportunity there. Yeah.
When I get this question, what? Go ahead.
Yeah. The other one was insurability. Sorry. Thanks. I kind of blacked out there for a minute. I'm back. But also insurability is a really big deal, right? Maybe this is probably better. Maybe I'll throw this to you, but when kids are young, man, there's not much of health risks that are associated with them, right? They typically don't have anything that's wrong with them. And so the underwriting process is really just pulling the medical records. And if there's nothing wrong, they're going to go through and they're going to get a standard rating. All juveniles get a standard rating. And so that policy is going to perform on a standard kind of portfolio or platform. But also what you're doing is you're preserving that insurability for the future. What about your kids?
Well, what I say when somebody, should I get it instead of myself, get on a kid, I think that they're missing the point. They're thinking too much about death benefit, right? The way we design this is to maximize cash value. Just in the example we talked about earlier, the 60 and the 40-year-old, the cash value is going to be the same in day one. Also, you go to the insurance company and say, hey, I don't want to get death benefit on me, but I want to get $1 million on my son who's 2.
Excuse me?
Right? And the insurance goes, well, what? I mean, the insurance companies are always concerned about risk. Like, why would you insure a child for $2 million when you don't insure the adult? So they're going to want to, before you can get insurance on the child, you're going to have to get insurance on yourself. And where, like how we've used the policies on our kids, is that's how we were going to pay for their education. I mean, my kids chose to go to college, but that college isn't for everybody. Yeah. Maybe they need to be educated by taking a course or starting a business or whatever that or is. So what we've done is, instead of, we were funding money into their 529 plans, but then we just reallocated that and put it into a policy on the kids. And now the cool thing is, now my kids are getting older, and now I get to share that with my kids and share with my son how this policy works. And like, okay, now it's yours. You try and use this. And once you prove that you can use it, then I'm going to gift it to you. Which now we start talking about legacy, and this, one of the reasons why we call this infinite wealth is because we want this wealth to be infinite. And before, a lot of our clients, they're going to have a lot of death benefit, more than they ever imagined, which means that their kids are going to get windfalls. So we need to start working with them now so they can learn to work with a little, so they'll be prepared for when they get a lot.
Well said. Well said. And awesome. And that brings us to the end of our frequently asked questions. Anthony, do you have any last words?
Of course I do. Okay. we're getting a lot of questions, and as we're growing, what we're going to start doing for our clients only is that we will be having meetings where it'll be like a webinar where people can ask questions. So if you are a client, be on the lookout. You'll be getting an email in the next couple of weeks of the first time we will be doing this. Do you have any other questions, Cam?
No. If you guys have questions, email them to us. This is kind of the frequently asked questions. We have a ton more that people ask as they kind of get introduced to this idea, but we'll do another one of these. These are just kind of the top 10, 15 questions that we come up with. And hope this is helpful.
Make it a fantastic day.
Take care.